Welcome, gentlemen. Welcome aboard as we are in the journey of the voyage to 2021. The entire discussion is about the next decade in real estate. If I take a step behind and look at the past decade, 2000 to 2010 decade was all about residential real estate. The 2010 to 20 decade was all about commercial real estate. We, in fact, sometime in 2013-14 peaked out in residential, and the prices has been stagnant for last 7-8 years. In commercial, we have seen a decent build up, and we have seen the rental prices going up almost 30-40% in last 7-8 years. What will the next decade be? That is what we are trying to decipher here. But before we start, Chanakya, let me take a step back and see what went right in the commercial real estate. What did private equity saw coming, and what was the thing which played out in the last 10 years?
So, thank you, Chanchal. Can you hear me? I'm sorry, yeah. I'm experiencing some trouble. Could you just repeat your question again? I lost you there a little bit.
Chanakya, I was talking about the commercial real estate. When private equity investors invested in 2010 to 12, what did they saw coming, and what played out in the last decade in the commercial real estate?
So I think, Chanchal, my immediate reaction would be the last decade has been quite transformational for commercial real estate. Particularly the office market. When I say commercial real estate, I also include retail. So as far as the office market is concerned, I think we've basically seen it moving from a non-institutional asset class to an institutional one, and that culminated with the listing of the Embassy REIT in April 19. I think prior to that, from the global financial crisis in 2009 to 2019, the whole decade, we saw quite a remarkable change in the caliber and the quality of the office market demand, primarily because India, basically made the journey from being a low-cost business process outsourcing location to a value-driven core global location for core competencies for major financial services companies and across sectors. Why just financial services companies? And I think what that did was it showcased Indian talent front and center, and that allowed global corporations to appreciate the depth and the quality of Indian talent, and basically one thing led to the other, and a lot more core functions started getting offshored. I know that's a little bit of a controversial word, but for the lack of a better one, offshored to India, and they are now called global competency centers or global in-house centers. There are various nomenclatures. So I think that has been the journey, and what that has done is that global corporations no longer look at India as just a cost arbitrage from a real estate infrastructure point of view, but actually look at it as a significant accretive or additive to their entire global corporate performance because of the quality of the talent they're able to leverage and across a number of competencies. So I think that has definitely benefited commercial office real estate. Retail, I think, is still early days. I mean, compared to even emerging markets like China or Brazil, India is a very small retail market. And I dare say that the pandemic has changed the rules quite dramatically globally for retail shopping centers. And it remains to be seen what impact that has in India. I mean, I'd like to think that it's still a very nascent market. So there will be opportunities. We are under-malled, if I can use that expression. So there seems to be logic for expansion. But I think, based on what we see in the Western Hemisphere, buying habits have changed quite dramatically. There is a massive pivot to online. And India is no different. I think India is on the verge of a cusp of a digital super cycle. And I think retail shopping centers will have to face that reality. Maybe not to the extent that we're seeing in the West, but there's a saying, when you look behind in your rearview mirror, things are much closer than they seem.
So interesting insight both on commercial and retail. I'll come back and debate on retail, but before that, let me pick up Vivek's view. Vivek, you must be meeting a lot of tenants. You have a big office market. With work from home, are you seeing some consolidation happening? Are people giving up some office space and renegotiating rentals? What is the scenario there?
For having me on the panel. Am I audible? There is some background noise.
Yeah, Vivek, you're audible. Yeah.
Okay, it's much better now. So I was just saying thank you for having me on the panel, Chanchal.
And Anuj has joined. Hi, Anuj. Happy to have you here.
Yeah, Chanchal, thank you.
Hi, Anuj. And good evening. So I think on the office side, I think we continue to remain having a positive outlook on our office business. Let me start by saying that. Right, you are right that we had a temporary blip in the occupancy, right? So actually, if I really look at our occupancy levels currently, it is currently at 91% from a pre-COVID of 95%, right? So it has actually dropped. So vacancy has increased by 4%, right? But if you really look at our collections, we are having in the last 9 months, that's upward of 99%, right? So good news on the collections. So let me talk a bit about the vacancy rates going up. And I think that's largely to do with the small tenants who had some financial difficulty during this COVID time. And they are especially in the sectors of co-working, hospitality, and e-commerce, who are largely providing services to hospitality business. But if you really look at a large chunk of our tenants, right, majority of our tenants, they are having strong balance sheet. They are amongst the 500 Fortune companies, and with, as I said, with relatively strong balance sheet. I think there is very little discussion we are having in terms of renegotiating the rentals or resetting the rental base, right? While with some of the tenants, which I'll say are smaller, who are still going through this financial difficulty, we are having a reset, but in my view, that's not going to be material, right? Having said that, in the last 6 months, if you really look at our assets under construction, we've got a very, very good response on the leasing side. So we have close to 3.5 million of assets under construction in Chennai and Gurgaon market, and almost of that, 38% has been pre-leased. So that's very, very encouraging sign. We are seeing that in Chennai, where Stanchart has signed a 8 lakh square feet office lease with us, right? Very recently, we signed a 2 lakh square feet lease in Gurgaon. So I think those trends are very encouraging. At the same time, we had a new office building called Cyber Park, which is now fully operational. A lot of tenants are operational there, and a large part of the tenants are close to completing the fit outs. So I think that's also very, very encouraging sign. So I think to sum up, I'll say this is a temporary blip, and we expect normalcy to restore in 3 to 4 quarters from now.
Sure. Thanks, Vivek. So Vivek, you are saying that this is a temporary blip. Anuj, to pick up from you here, you think, the office market, the fact of the matter is that the absorption has gone down from the peak absorption of 54 to 27 this year. You think that the office market or rentals will be stagnant for 2-3 years before we see any pickup in the demand for commercial? And also, but bringing up retail real estate, given that work out of home is the new norm, and weekends and weekdays are similar for almost all of us, do you think retail real estate will pick up in India? The supply is less. People want to go to a good quality mall. What's your view on both this asset class?
Yeah, so very interesting. I was listening to what Vivek said, and Vivek bang on. Most of the listed guys, if you look at it, and you pick up the REIT guys' balance sheet, are very similar to what you have said. The vacancy rate is in the low 90s. The collections, which has been fantastic, Vivek, is 99%. The occupiers who have left are in the retail, hospitality, food court, that sort of space. And the pre-leasing has been pretty strong. And Chanchal, to come to your question on that is, we are seeing two aspects of it. One, grade A quality space is doing better than grade B, grade C. You will continue to see is that most of the listed guys, because they deliver A quality grade space, they are the ones who are going to pick up momentum, pick up the speed on the leasing. So overall market will shrink. You're exactly right. It may be at 50, 55, 60% of 2019 and 2020. And our thought is it may increase a little bit, but still it will not get to 2019 levels. But yet you will see is many of the listed developers leasing activity very vibrant because they're delivering A grade office space and the occupiers are exiting B and C grade office spaces. And that's where they will continue to benefit on the office. On the retail, I agree with Chan. What he said is, I'm absolutely sure on this, Chanchal, and I don't know whether the viewers are from America, Europe, or the rest of the Asia Pac. They are going to have a negative view on retail because internationally, in more mature markets, it has had a big impact. I don't think India will have that kind of impact. Chan is right. There will be an impact because of the e-commerce, because we are under-penetrated on organized retail real estate, unlike the more mature Western economies, which have a lot of the mall spaces, and hence, from their perspective, they are going to see, or they are seeing the impact we may not see. Second, Chanchal, is that, it is a social space for us. I mean, we don't have museums and parks and central parks where we can actually go in. For us, entertainment over the weekend is, going and meeting up with friends and family in a mall. So unlike some of the more mature markets where there are other things to do on a weekend where you are able to culminate and that becomes your social fabric, in India, mall is that space. So I don't think it is going to get replaced the way that in more mature markets have been done. Yet I agree with what Chan is saying is that the profile of the tenants, Chanchal, the profile of the retailers will have to go through a change. Would I go back to the mall to buy a white shirt that I'm wearing? Perhaps not. I'm very happy to do it online. Yeah, but it'll have to be different category of retailers, more experiential, more sort of smell, touch, feel, sound, that sort of a thing that you will have to do. A lot of F&B, a lot of entertainment. That is the experiential retail that you will have to bring rather than what was being sold, because that all may today be sold very conveniently online and the consumer is happy to buy that online. But these will remain very vibrant social places where you will see a lot of the footfalls continue to happen. By the way, Chanchal, if I can just add very quickly, and Vivek will know this quite well, the footfalls in the malls, in the good malls, are about 75% of the pre-COVID level, yet the consumption is 87%. Of the pre-COVID level. So, you're really coming back nearly to normal consumption levels.
Thanks, Anuj. That was useful. So, grade A office space will see the occupancy not coming down, and probably quality malls is here to stay, and probably they will grow big. Though the consolidation may happen at the non-quality space. Chanakya, you spoke about REIT while you were talking about it. How has India done in terms of the REIT regulations? We have seen 2 REIT listing. The third is on the pipeline. Has India matured enough, and you will see a lot of REITs in Indian market?
Yeah, so look, my take on the situation is, I'll preface my response by saying you mustn't forget that the Indian real estate market, for all practical purposes, from an institutional investor point of view, is only 15 years old or 16 years old, to be precise. 2005 was when the market was opened up for foreign investors. So everything that I say must be seen in that context. And I would say that the market has done a phenomenal job. And I think the regulators have done an absolutely terrific job of being able to, first of all, benchmark regulation to global markets like Australia and the UK and the US. And so in that sense, from get-go, they've adopted gold standard with the retail investor in mind and their safety and security, promoting a complete transparency to make sure that dividend yields income goes back to them to the extent of 90%, and so on and so forth. And I think the proof of the pudding is in the fact that, don't take my word for it, look at the performance of the 3 REITs thus far, including the Brookfield one. If you take the Embassy REIT in April 19, there was hardly any mutual fund participation, domestic mutual fund participation. It was primarily book built by foreign institutional investors. If you look at Mindspace, it increased somewhat more. If you look at the follow-on issuance by Embassy REIT in December, there was some more participation. And now if you look at the Brookfield REIT, it's primarily domestic. And I think that kind of tells you that domestic investors are now getting more familiar with the concept, and they appreciate the product in a low yield environment, where these REITs have a potential to grow both in terms of scale of volume as well as ability to scale up their NOIs because of opportunities either by way of cheaper refinancing or by way of under renting and so on and so forth. And so I think investors are also becoming more discerning. Retail investors and domestic institutional investors are becoming less suspecting, I would say. And that's very good news because we need a very strong, deep domestic investor profile rather than relying on foreigners coming in to buy units alone.
Sure.
I think the other factor that I would say is very encouraging from a regulatory standpoint is now the new proposal in the new finance bill to allow dividend income to be tax exempt. Basically, they're throwing out the red carpet. I don't think the government can do much more. I mean, they've virtually acceded to all requests that have come from industry. And finally, I think the allowing FPIs to come in and invest in debt issued by REITs is another accretive instrument for REITs to basically increase yields for investors. And so I think for a variety of reasons, I'm quite enthused as a foreign investor, because if I bring in capital in the country, the first thing I look for is what are my modes of exit? Do I have to bring in another foreigner to buy what I'm building out here? And clearly, I think the ability to exit to domestics is very, very encouraging.
Sure. Thanks, Chanakya. In fact, that would be music to the ears of Vivek, the fourth REIT in the pipeline, probably. So next decade we'll see a lot of REIT happening, and the Indian market will probably mature in the REIT space. But coming to residential real estate, Anuj, I want to bring you in because you do a lot of work here. Has the pandemic taught people the importance of owning a property, and people want to own bigger home? Something triggers a new cycle. Is this a start of a new residential real estate cycle?
So, Chanchal, very, very good question. I don't have an answer to that, whether it is the start of a cycle. But I tell you, Chanchal, when this lockdown happened, end of March, we guys were scared. April, May were scary months. That, our thought was, who's ever going to buy resi? In this market, your job security wasn't there. Commissions, bonuses were just not there. Salary increments weren't there, and spending that kind of money as an outlay was difficult to witness. And then I remember speaking with someone very senior in the US, and he sent me Wall Street Journal's article. It was sort of August, September time, and it said US resi sales in those 5 months had touched a 14-year high. And at that time, Chanchal, our Bangalore office opened and it just did exceptionally well, as if there was no COVID that had happened. And we thought maybe this is a pent-up demand. And then slowly the rest of the offices opened. Second office was NCR. DLF did a fantastic job. We were partnering them in Lucknow. It was like a 24-hour sellout that happened in there. And we thought it is perhaps a pent-up demand. And our thought was, Chanchal, that this will start to wane down by October, November, December. And by December, definitely, this is going to fall off the cliff. January has been equally strong. And, because we sell about 20,000 apartments a year. So, Chanchal, we have visibility of the next 3 to 4 months, because the footfalls by now should have gone down. If it was not going to be something that was sustainable, the footfalls continue to remain as vibrant as ever. So, it does appear that it is well going into April, May as a very strong cycle. So to answer your question, it looks like that it is beginning of a sort of 5, 6, 7 year resi cycle. I hope this time, Chanchal, we have the right players who are rallying. And why I say that is, in the past, in 2008, when the global financial crisis happened, 2009 made the market came back. It was like a wave that came back. All the fishes that were on the side, which were the developers, they took all the fishes back and everybody swam. This time, I hope that the consolidation phase comes in, that it does not pick up, the fishes who had spoiled the market, and they leave it on the shore, and it's only the more corporate governed, financially disciplined, customer focused, delivery focused fishes that actually go in there. And to my mind, Chanchal, that is what is going to happen. It will be a very selective cycle that will come in. And 2 data points I'll give you very quickly. One, we did an analysis and we discovered that from 2012, and I'm just reading it out, 2012 to 2020, 53% of the developers had gone out of business in the top 14 cities. We put down all the developers, 53% of the developers had exited the market. The second data point I give you is that the share of the listed and leading developers, so listed and non-listed, but leading developers in the various micro markets of these 14 cities, the overall sales increased from 17% market share that these guys had in financial year 2017 to our expectation is that March 2021, it will be 44%. So half of the market is now getting consolidated with very few people, and hence in a market again where you will see a reduced take-up of inventory in the financial year 2020-2021, many listed guys will do exceptionally well. So just your viewers will hear a contrasting statement that the market has shrunk, yet some of the guys have done much better because it is the wave only taking selective fishes back into the sea.
So, just to sum it up, December quarter was the highest ever quarterly volume we saw in last 10, 12 years. And we've seen a consolidation happening in this space. Vivek, to get you in, consolidation has happened. We have seen reform like RERA playing out. 53% of the developers have gone out. What will be the success of the developers in the new era? How do you think the game is up to you to play? If you will be able to scale from 2-3 million square foot to 10 million square foot, what are the building blocks for DLF which you will play out in the next 3 to 4 years?
Okay, thanks, Chanchal. A lot of questions in one. Let me start. So I think you are right. I think DLF is fully geared up to catch the next cycle of growth, and I'll explain you how. I think first of all, we've announced our product pipeline, a very diversified product pipeline of 35 million square feet, which we are going to launch in the next 4 to 5 years. In fact, this time we've also shared with the analysts our launch plan, right? So that's one. And when I talk about the launches, we are actually really launching our product in established locations. I think that's something. Which is a very strong point we have. And we are actually diversifying our product portfolio in line with the consumer demand, right? So we've always been present in premium and luxury. Now we've got into value homes, and we've also added a portfolio on the commercial side. That's one. Having said that, we are also really making sure that we stay with the core, right? When I talk about the core in terms of our product and also in terms of the geographies, which are our core geographies, NCR. At the same time, we are also entering into the market where we already entered at some point in time, right? So we are not trying to really get into a completely new market, but certainly we are looking out for something in West, in South, which we had done at some point in time, right? So I think one very clearly, as I talked about our launch plan, which is very diversified in terms of product portfolio, in terms of geographies, and in established locations. So that's something which we are really confident about. Secondly, our business model. I think we are also really looking at the way the demand is moving, the consumer preferences are moving, right? And we have also tweaked our business model in line with that. So a large part of our development, we've kept it in the cycle of 18 to 24 months to really make sure that we have a good cash conversion rate. That's something very, very important. And also all our new product offerings are going to be either margin accretive or margin protective. We are not really going to dilute our margin. So I think that's something which we've also kept at the back of our mind. And third, earlier, unlike in the past where we were building and selling, now I don't have to really complete the construction. We can start selling it after we launch. So I think that's the changes in our business model, what we've made. And we've already started to see a very, very positive impact of that. And you've seen that in our results in the last 2 quarters. So that's the second thing I'll say. Third thing, I think we are really investing in organization capabilities, right? While you may have a best of plan, you may have consumer demand, but unless you know how to execute it on the ground, it's of no use. So therefore, we are investing in organization capabilities. I think we have now, half of our leadership team is new, which has come from different industries. They've come from different backgrounds, right? We've had a rehire across.
Yeah, in fact, it was not heard of when you came from FMCG background, a legal and Lexo background to a DLF. So the pipeline and institutionalizing the process is happening in the residential market. Good to see that.
No, you are absolutely right. Right. For me, I was always in the business of selling soaps, right? Right. A 10 rupee soap. Now I'm selling an apartment which starts from 2 crores. So that's the big shift I have seen, right? And so is the other leadership team who we have now on board. We have people from Coke, right? We have people from IT industry, and we've also hired people from real estate industry, right? Different age groups. So I think there is a lot of diversity in our leadership team, and the same thing has actually flown down the organization. We've strengthened our IT capabilities. We are upgrading our ERP. We are investing in our processes. We are redoing all our processes. We are strengthening our procurement function. So I think those are the other capabilities. And in fact, we are bringing in a lot of technology into the construction, right? So there is a traditional way of really constructing a building, and we are really looking at using technology in the way we do things, which is more cost effective and also shortens the period of construction, right? I think this organization capability, as I talked about, all these three really gives us that confidence that we are really getting ready for the next cycle of growth.
Interesting, diversified, launching 35 million square foot, you're preparing, gearing up for the new cycle. Chanakya, just your brains. Why private equity investment always comes in commercial? Why have you guys not invested in residential? Any thoughts on those? And second is, do you think is there money to be made in affordable housing?
Great question, Chanchal. I was wondering why you hadn't asked that earlier. I think the simple answer is, there is a lack of alignment of interest. I mean, I'm talking generally. I'm not making any specific comments. Equity is not respected. Private equity is not respected in its truest form in the for sale resi market. So the lack of alignment, when I say, I refer to the fact the lack of promoter equity in residential projects. DLF, like Vivek explained just now, is a rare commodity in this market where they're actually building and then selling. Thus far, if you look at the last decade, why has there been a lull in sales? There's a very simple reason. It's a trust deficit. It's not lack of demand. It's not lack of demand. So what was happening was developers were being fueled by this so-called steroid, which was in the form of capital from various NBFCs, which were at unsustainable, interest rates, and as a result, the whole capital stack was either private equity investor equity, NBFC capital, which was preferred equity or preferred debt, and then there was customer advances. And as a result, in such a model, when the moment the demand nosedives, your business model falls flat, and the equity holder is left holding the can. That is what has happened. I mean, if you look at the foreign investor experience in private equity in for sale residential, it has been a disaster.
Sure.
And I think that is a lesson that needs to be taken away. One of the things that Anuj referred to, why is there consolidation happening? Why is 53% of the developer lot exited? Because they had no skin in the game. They were just having a free ride on the margins. And the moment the market didn't perform, they had no other way to go. And retail investors were left holding the can. And I think this is a fundamental change that RERA has brought about, forced change in terms of behavioral patterns, that these, riffraff and, have been exited the market. The residential market is going through a corporatization. You're going to see more and more corporate entities come in because this is a real opportunity. The Indians are genuinely, there is a lack of housing. And I think the fact that Anuj referred to the successful launches in the mid-income residential market is a testimony to that. The final point I would make is, in a marketplace where today we are on a tax deducted adjusted basis, the interest rates are at about 2.5%. Even if you didn't need a house, you should buy a house. Because just the positive carry that you have the ability to have some capital appreciation, and even if it is just a positive carry, a spread of about 1% over your cost of debt on an adjusted basis, it still makes sense. But so demand has never been the issue. It has been the lack of ethical ecosystem, generally speaking, and I think that is now going to change. We are in the middle of the whole market. I'm not just talking about Resi, but generally the Indian real estate market is going through a massive formalization process. So I think the next 2 decades, I think you're going to see what has happened in other developed markets happening in India. And I completely agree with Anuj in that let's not get euphoric. Nothing is as bad as it seems, and nothing is as good as they make it out to be. So you have to have a sense of balance. So in that sense, I think I hope I have answered your question in a roundabout way.
No, thanks, Chanakya. Thanks. Coming to Anuj, most of the viewers would be interested. So there's a supply consolidation which is happening. There's a demand which is there, and demand probably has strengthened now. So and the prices have not gone for last 5-6 years anything. Do you think next 4-5 years or next 10 years we'll see a huge uptick in the price because supply is limited, demand is there? It's a demand-supply mismatch, and property prices have not gone up. The input prices have been going up. What's your view on the real estate prices?
Yeah. So Chanchal, when Chan was speaking, a phrase came to my mind. I was in the US just before the pandemic, and I asked the same question, Chanchal, that you asked Chan, to one of the private equity guys, to say, sir, why are you not looking at investing into equities in residential? He turned his computer and there was a yellow post-it on it. It said India, INDIA. I will never do it again.
Will it change in the next decade?
And I said, what happened? And exactly what Chan said is, Anuj, simple. We are in the business of investing money. We make money, we lose money. That's okay. But, I don't understand one thing on residential in India. My partner made money. product made money. Why did I not make money? I think it's very difficult to answer that. And exactly, Chan, what you said this is exactly what it was. We think is that the market is now gone through that consolidation, and over the next few quarters, you will start to see players where there will be private equity who will start to invest coming in at a project level. To answer your question, Chanchal, on the pricing, look, if you look at most of the listed balance sheets, I mean, look at the margin percentage that they have on the residential business. It is very, very thin. For the effort versus the reward, for the risk versus the reward, it is just not commensurate. So, given where the input prices have gone, there will have to be two things that happen. Either, Chanchal, the land values have to start to come down dramatically for the developer to be able to make some margin percentage, or the sale price has to increase. My thought is it is going to be a combination of both. There will be some elasticity on the sale price. It's not that people's salaries have gone so high that they will be able to accommodate the full increase in the sale price. There will be an accommodation at the land valuation, and there will be an increase in the sale price. I have no doubt. By the way, Chanchal, in Bombay, we've started to see that already happen. In majority of the projects, we started to see the price rise. I think it'll be reasonable. I hope it continues to remain reasonable in the affordability bracket, but we started to see 3 to 5% increase in the price already. So as the consolidation happens, supply gets consolidated, the unwarranted players who were discounting unnecessarily the product without the intent of being able to deliver that product, they're moving away from the market, and the serious players who are remaining are starting to now increase the price just to make sure that there is sufficient margin for the efforts that they're putting in.
Sure. Thanks, Anuj.
Can I make an additional point? To Anuj's point, I think the other reason why you're going to see a further consolidation and therefore price rise is, I don't know if you have seen the new consultative paper that RBI has come out on NBFCs.
Yeah.
The negative bias of the regulator on NBFCs lending to real estate is going to lead to further consolidation, and that is indirectly going to lead to inevitable price rise.
Sure. I think we are running short on time. This can go on for one more than 2 hours now, if I want to. But I will end. I would like to end with a tough questions to all three of you. Next decade, if you were to invest, will you do it in equity or will you do it in real estate? Anyone can go as you feel like. Who want to start? Anuj, you want to start?
So Chanchal, I think it is not or. I think it is and only. Clearly, on the real estate, particularly on the residential, Chanchal, it has now become more of a social security. So, if you're buying it for your end use, please go ahead and buy. If you're thinking you are going to be a speculator in this market, I would suggest don't come in. This is not a speculator's market to come in. But for the end use, please, whatever your savings, whatever your income is, 33% of it, put it towards buying your home where you want to live in.
So end use buy, and then remaining you can invest in equity. Chanakya, your view?
Yeah, I think I agree with that sentiment. Absolutely. I mean, and for me as a real estate investor, I would first invest in the asset class that I understand the most. And that's the way I look at it. I mean, don't try and be everything to everybody.
Sure, that's interesting. Vivek, your view?
See, very similar, but I'll say I'll allocate my capital in a balanced and in a diversified manner, as most of us do, between real estate and equity and other class of assets. Right. Let me start with real estate. I think Anuj talked about it. What is important is that if you really look at the pricing in the real estate in the last 5 years, it has been low single digit. And if I adjust for inflation, it is almost negative, right? And I think we are seeing pricing moving up, right? Not only in Mumbai, but in other markets as well, right? So we just started to see that. And with commodities actually prices going up, I think that is that is a way to also, you will see that also getting reflected in the pricing. And we are seeing it after a very long time, and we are seeing a good demand traction as we speak. So therefore, putting money in real estate is going to be a very, very attractive proposition as I speak. At the same time, if you really look at equity markets, they are also having a dream run, right? Right, Sensex is at all-time high, 50,000 plus, right? If you look at Nifty Reality, right, that's also grown 100% since April, right? Even DLF share price has really moved up by 130%. And like
Chanakya was just saying it's a $10 billion market cap today.
Yeah. So today it's a $10 billion market as we speak, right? So I'm not sure what happens after we finish the call, but before we started, that was the number, right? So I think both asset class to me are attractive from a real estate point.
Sure. Thanks. It was nice having all of you. So to end the discussion, next decade will be about both the asset class. You choose how much you want to invest, but be invested. Thank you, everyone.
Bye.
Thank you.
Bye. Bye.